Welcome to the Chinchilla Picking Podcast with your hosts, Brandon Beaver and David Underwood.
All right, guys. Hey, welcome. Sorry I couldn't make it the last time. I was very not doing well with my vaccine shot, man. I got that new vaccine shot, and I had some adverse side effects to it, and I was kind of out of it for a few days there. So Brandon had to roll solo, if you will, on the first one. And I appreciate him doing that. I thought he did a great job there, Brandon.
Yeah, thank you, man.
No
problem. Hey, I was really nervous, but it's okay because it turns out I'm really good at this.
Yes. I heard. You know, my dad called in. He said he turned you on and it helped him go to sleep the other day. So that was appreciative. Anyways, yes. Brandon and I have known each other quite a long time, so we will lovingly and as brothers take jabs at each other for fun, and it makes us laugh, and that's all that's about. But no, chinchilla picking. That's why we're here. We're here to be entertaining, educational, and uplifting, and we want everyone to make money. So let's get into it. What do you say? Brandon and I, how the show works, I want to kind of repeat this, take a minute to repeat it, kind of beginning each show, is we have topics that we bring to the table, and we do a quick meeting about 20 minutes before we start recording, and we kind of go over what our topics we want to cover. We don't discuss them at that moment. We just go over them. And, being this our first show, of course, Brandon and I would have one that we both wanted to cover at the same time. So we'll save that for later on in the show. But being as I won the coin toss this week, or Brandon got to run the show last week, however you want to look at it, I get to start off with some of the picks I chose. And so that means I'm going to be more well-prepared than Brandon will be. He's only had a few minutes to prepare and discuss. But one of the ones I wanted to chat about had to do with why I was out last week, the vaccines. So as we look into the vaccines and these vaccine companies, Brandon, one of the things I mentioned when we met up like 10 minutes before the show, I said I want to talk about Activision and Novavax. And the things I wanted to talk about was they're jumping right now because they're getting these vaccine news and these study news and clinical trials news, and everyone is saying, okay, this one's going to jump up and it's going to make a lot of money and it's going to be good for the company. And yes, they have some sales already set in place, some, not much. But, and this is the headline I want to lead with our discussion here, CNBC, USA Today, and among others are stating that the U.S. could be, quote, unquote, swimming in vaccines in less than a month. So why are these stocks jumping if they're not even available yet?
Well, there's a lot of FOMO in the market. There's a lot of retail investors and a lot of new people that have gotten into the market that I think that are trying to make money quick, trying to get rich quick. And quite frankly, usually that doesn't work out very well. So I'm not certain that there's a lot of thought put into it. I just think it's a reaction of people, just other people are buying, so I'm going to buy too. I don't know much about.
Isn't it we sell the news? Since when is it you buy the news? When did that become a thing? Wasn't it you sell the news? Because it's you knew about this coming. You knew these things were going to come. You've already bought into the stocks. And when the news breaks, you sell and you take your profits.
Right. And I see that a lot now with earnings when you get on Facebook and you see these Robinhood chat groups and stuff like that. And then everybody gets on to a stock and then they buy for earnings and the earnings comes out and then they're like, well, why'd the stock go down? Well, that was because it was the sell the news kind of thing. You want to buy before everybody else buys, not when everybody else is buying, but before they buy. And that can be very...
Yeah, okay. Now, earnings, to me, that's apples and oranges, all right? Because, yes, there are some earnings that are that way. There are. But earnings actually has news that you don't know about until the moment that you shouldn't know about until the moment it's released. So that to me that's a little different. I kind of get that. And yes, you're right. There's a lot more into it than that. There's the guidance. There's a forecast. If you're looking at retail, it's same store sales. You're looking at different growths. If you're looking at Netflix, you want subscribers. If you're looking at Tesla, how many units did they make? There's other details in there besides just the raw earnings data or the EBITDA and all that stuff. There's a lot more to it. You know what I mean? But I mean, with stuff like these vaccines, we knew they were coming for a long time, right? And yes, their trials are showing some promising gains, but Moderna and Pfizer are already leading the group. Johnson & Johnson's right there behind them. I mean, we've already got millions of Americans already vaccinated. I don't see them justifying the jumps. I mean, just when I wrote this down, Brandon, it was at like at 415, 420, and Novavax was at 218, and it was up $46.
Jeez.
It went all the way up to 265. It went up to 265, and I was just like, why? Is this retail investors, or is there actually some actual people on the street, companies moving this here?
If it is the street, if it is institutions, I think it has to be retail investors triggering their computer algorithms to buy. Otherwise, there's no explanation for it, because the only thing I see is that it's got to be people who are seeing the stock jump, and these are newbies and rookies into the trading world, and they're chasing. One of the things you have to think about too, other than just vaccines, outside of the vaccine news, when it comes to pharmaceuticals, you have to be very careful. They spend a ton of money on research and development only for whatever product they have put out there. That first of all, it has to go through the testing of the FDA, and then once it's tested by the FDA, it has a certain amount of time on the market before generics are released, and their profits are completely obliterated by that. So then they have to go back into R&D again to spend more money on R&D to release another product and go through the cycle. This is why I'm not really a big fan of pharmaceuticals, but you really have to look at these things, especially with these companies that aren't that big, that aren't really that competitive with the Johnsons and Johnsons of the world, and you have to be extra, you have to scrutinize it extra, I think.
Yeah, no. And unlike you, I like pharmaceuticals, biopharmas, mid-grade and small-grade companies. Why? Because I like huge returns when they have big news at 6 in the morning, 7 in the morning, when I'm awake doing my pre-market trading. That's what I like to see. However, in this case of Activision, so a lot of people made a ton of money, right? Because it went from like pennies to $9 and some odd right now, all in this past year. My worry is that we saw the CEO of Activision on CNBC today around 4:45, 5 o'clock, and he's on TV, and I don't know. It looked like he was kind of pleading there with people trying to state the case as to why he should get contracts. He was stating the case of our vaccine can be given to children, and right now the vaccines you have right now are only for 16 and older. I'm like, why are you on national program sitting there trying to make a case for why we should use your drug if you were not in trouble, if you were not needing contracts in order to justify your stock price? I worry about Activision. I don't see it going. I mean, I can't see it. Yes, you can day trade it right now and make money. Yes, I'm not going to say you can't, because you can. You can day trade Activision right now, but it's risky because it could drop at any moment because they don't have the contracts to justify the valuation. Now, Novavax, there's other things there. I still think it's a little overvalued. But there are other things with that company, and it's not a one pony show there. So, but Activision is a one pony show, and I can't see them justifying that. I don't know.
Oh, lots of competition too.
Yeah. Oh yeah. There's a $1 million to the fight now. Same thing with another company, but we're not going to get in there. We're not going to have time to get into that one. But that one starts with a T, ends with an A, and there's a lot of dogs showing up to that fight now as well. All right.
Who knew? Who knew we would have TNA on the Chinchilla Picking podcast?
Right. Oh, nice. All right, so I get two more sections before I hand it over to Brandon. So my next section, again, this is one Brandon only had 10 minutes to do a little bit of research on whatever he could muster. I wanted to talk a little bit about gaming, considering a lot of people were locked down last year, and if anything changed in the gaming industry. Now, I am definitely biased in this regard, because I have 4 different consoles for virtual reality alone. So I am a gamer. I do enjoy my VR. I do also enjoy Xbox, not PlayStation. I'm sorry if that ruffles your feathers out there. But I'm going to list you off a bunch of stats, and then I want to, kind of discuss where we see this going in the future, and if you're in agreement with me, Brandon, on this or not. So last year, right? Last year, the total number of Steam users that had a VR set went from 1% to 2%. It doubled. Doesn't sound like a lot, right? Not a whole lot there. Can't see much, but it did double while we were locked down. In March of 2020, this is March, mind you, there was 73% of all 169 million U.S. gamers, people who said they were a gamer in the United States, 170 million of them. 73% of them owned a console of some sort, right? Of that 170 million gamers, only 29% owned the VR system, and that was in March. Now, here's why I say that, because the Quest 2 did not come out for sale until near fall, in the summer, and during that time in 2020, in the summer until the end of the year, the Quest 2 sold 1.2 million units, right? Around that same time, PlayStation came out, and they sold 4.5 million units. That's a PlayStation 5, the one we saw all over TikTok, all over Instagram, all over Facebook. It was everywhere, right? That's up there with the big boys. Now they're starting to compete with them on console sales, right? They're estimated to sell 3 million Quest 2 units in 2021. That does put them up there with Microsoft and Sony PlayStation. They had a game last year. So they had 60 games last year that grossed over $1 million. First time they've ever had that many games. They had one game, Walking Dead Saints and Sinners, grossed $29 million. And it's an Oculus-only game. So you can't even get on Steam. I think you could get on Steam now, but you couldn't get it on Steam when it first came out. You can only get on Oculus store. Now, that doesn't sound like a lot, but that's huge for VR. Now, when you compare it to Red Dead Redemption, which pulled in 725 million in its first month, it's it still has a long way to go. But I believe there's a future in investing in VR. Go ahead, Brandon. I've talked enough.
Well, you know who else agrees with you?
Who's that?
Tim Cook, apparently, of Apple. They're getting their own headset. Microsoft as well. So yeah, I 100% agree with you. And I think that gaming is going to change our lives even more than it already has. My first introduction to AI was through playing the computer on, Madden 95 or whatever I was playing on. And you also have to think about this too. Long-term future growth for gaming. I don't know about you, but my parents don't play Xbox or PlayStation. When we're their age, we'll be playing Grand Theft Auto 60 or whatever it's going to be at that point. And so will our kids. So I still think there's a lot of room for gaming and VR as well. It's one of the reasons why I recently bought back into Apple stock, was because of augmented reality and virtual reality. So we're 100% in agreement here.
You know who isn't in augmented reality? I don't know if you ever thought about this as an augmented reality play. The but it'll be Snap. Snap has a lot of augmented reality,
Yeah.
and they've invested a lot of money into it. That is
Hmm.
definitely one of the top ones there that has definitely pulled in their money. And I had a couple other things here I wanted to show up. Yes, I'm working my computer as we do this. Um, so one of the side investments I want to look at is the Qualcomm, right? So Qualcomm
Right.
makes the Snapdragon XR2 chipset platform. It's that platform that allows the Quest 2 to be a standalone, no wires, right? And it's the Quest 2 console that is really driving these sales right now for Oculus, or i.e. Facebook, um, in in the VR field. And so, I mean, is Qualcomm a play on it? And then another play on it is also my favorite stock of all time. I don't know if any of you guys who followed us during our Facebook group years, but NVIDIA is you have to have an NVIDIA chip just about in your computer if you want to do PC powered VR. And so NVIDIA is another great play as these growth areas move on, because if you want the graphics, you're going to have NVIDIA. If you want the standalone augmented VR, what have you, Qualcomm's the play there. And I think there's growth in these. And I think the big companies like Activision are going to have to start making some games for them, because Activision's stock dropped recently. I don't know if you've been watching, paying attention, but they did have a big drop recently, the past couple days. Um, they keep now Activision saying they're going to look to strengthen. They're going to keep going up. They're going to post year over year growth of 20.69%. Yeah, they could, but I mean, people are getting kind of bored with consoles and the same games. Oh, it's new Call of Duty, new, you know, Grand Theft Auto. It's the same games. We want something different.
Yeah. Everything's a rehash now, and
It, it, it,
that's
it, yeah,
big.
yeah, and I think VR is the way they're going. So Qualcomm, that's a good buy. NVIDIA is all. I mean, it's hard to go wrong in NVIDIA unless the whole economy as a whole is doing bad, and then you just wait for the dip, wait for it to drop all the way down, and you buy it.
Yeah.
Because they just make solid chips, solid chips. I love NVIDIA as a
If
company.
if they ever do a VR Red Dead though, I'll probably starve to death and lose my job. So I
if they
will
do,
forget
hey,
who I am for a whole week.
if they do a Red Dead VR, you got to come over here. Use one of my VR consoles. I have the best. I have the arms and legs on order. It's coming. So we'll strap you in. We'll have you feel everything, and you'll have the best time of your life.
Yeah, that's great. As long as you have like those boundaries set up so that people don't see me wearing weird glasses and pretending to ride a horse down the street.
And that was me on Saturday last week. What can I say? It was a Saturday. I was off work. Uh, right on. So we're both in agreement. There you go. Let's move on. All right. So this is the one that Brandon and I both wanted to talk about here. We both brought this up, and it's definitely something. So it's going to be more of a back and forth here, because we should be both studied on it. I'll lead it off with a couple comments, and then I'll let Brandon say what he wants to say as well. Last year, 2020, crazy year for investing, crazy year for the stock market. I've seen years like this before. Right after the Great Recession, that big V in the market during that time. I've lived through these. This is only the second one I've actually traded through, though, as an adult trader, and it's crazy. These don't happen often, guys. This is not the normal. I believe it was a lot of people at home bored, got some stimulus money coming in. Let's make some trades. Let's get going. Um, there's one thing I want to say, and then I'm going to let Brandon talk, because I know he has a lot he wants to say on this. So the last thing I'm going to say here is, guys, these returns are not sustainable unless you're on the inside of every single solitary Reddit group bounce. And even those, who knows how much longer they can keep moving stocks the way they are. Maybe they could keep doing it. I don't know. This is all new to everybody. But I just can't see it being sustainable, these kind of returns constantly. It's got this is not how you things are normally, and this is not how we've all made money years before this. Go ahead, Brandon.
The function of market corrections, and we saw the NASDAQ go into correction territory last week, dipped down into about 10%. And I told you guys, tech's not dead. It's still not dead. But
bonds are dead. Bonds are dead.
Okay. Okay, CNBC. Gosh. But the function of market corrections is to flush out the mistakes that the market's made. And generally, it's fairly easy for me and for a lot of experienced traders and investors to see where the mistakes are made. You can watch what the institutions are doing. You can see their computers, their algorithms, whatever it was. They made a mistake by selling a certain company. A great example of that, I think, was when the first time the GameStop thing was happening, and the hedge funds had to sell their Apple and Amazon positions in order to cover their GameStop losses. And you really should have been right behind them, picking up those big cap great stocks that got sold off because of that, because it was a great deal. But as I said, the function of market corrections is to flush out mistakes. And so you really need to make sure that you are not in one of those mistakes. One of the ways to do that is to dig into the company's balance sheets. Hopefully you actually do it before you invest in the company. So we're going to go over some basics of value investing. So when it comes to balance sheets, when you're looking at them, first of all, you want a gross profit in the company that you're looking at. Really preferably over 40% is a good gross profit. When you're looking at the income statement as well, you'll see something called SGA. That's selling and general administrative costs. Preferably you want it to be under 30%. Plenty of good companies have SGA costs between 30 and 80%, but preferably under 30%. These are just general rules. So if you've got a good company like that you're looking at, and one of these rules doesn't make sense to that company, that's fine. But it's good to look at, right? So 40% gross profit margin and 80% of selling in general. I'm sorry, less than 80% of selling general administrative costs. Definitely less than 80%, preferably under 30. Okay. And then if you go down more on the balance sheet, you'll see interest payments. Those are relative to operating income. They're financial costs. Companies with no or little interest payments are preferable. And if you really want to look at percent of operating income, if you're looking at the income statement again, income before tax. Income before tax is income after expenses but before tax. Okay. Net earnings after all expenses have been deducted from a company's revenue. That's where you get net earnings from. And you want to see a historical uptrend on net earnings when you're looking at a balance sheet. Okay. Or income statement is where that's from. Balance sheets are actually separate from income statements. Balance sheets are for set dates. So each fiscal quarter will contain a balance sheet for earnings for a particular company. And on the balance sheet, you'll find the following. So you see current liabilities. Those are liabilities that are owed within the year. Long-term liabilities come due in a year or more. Shareholder equity, if you want to calculate the shareholder equity of your company, you take all assets and subtract all liabilities to get the shareholder equity. Current assets referred to working assets. And when you're looking at this, you see the process of cash goes to buy inventory. Then the company uses the inventory to sell to customers. and that then converts to cash, right? That's the business cycle. Short-term investments equal the cost, or you go from short-term investments to the cost of inventory to total receivables, which is cash. Companies with a competitive advantage make cash faster than they can spend it. So it piles up, right? So if you see a company that is consistently generating cash, that's awesome. Check the cash and equivalents for the past, I would say, at least 5 years going back. That way you can get a good generalization of how the company operates historically as well.
And this is all for investing, correct?
Yes, this is investing. I'm sorry. As we've talked about this before, previous podcast, I think I mentioned it. Investing is different from trading. Trading is you're going on, obviously, technicals and charting and stuff like that. And you can kind of mix in.
All right, I'm going to stop you right there, buddy. Yes, trading, you can use charts. I know some people who trade using charts. Trading can also be done, and this is my philosophy. Trading can also be done by getting the emotion of the market at the time, the macro events, the news wires. You know, was there a bomb dropped in the Saudi Arabian oil fields and oil shooting up? Then what's ExxonMobil doing, right? You know, that kind of thing. That's how I trade, and that's what I trade off of. So when some people ask me, like, you know, what do you day trading today? And sometimes I don't have a microeconomic, fundamental reason for it, but I have all these emotional market headline reasons for it. And that's what I'm trading, because I'm looking to make my little bit there. Sorry, I didn't mean to cut you off, but charts are not the only way to day trade. Sorry, that was my point.
No, you're good. And then there's also another thing that you can do too when it comes to that. And I've done this in the past. You look for things that get priced out of a stock. So, for example, last year, okay, Disney, the parks closed down. All right, but they were also working on Disney Plus. And they also had a 67 and still have a 67% ownership of Hulu, right? Because the parks closed down, everybody forgot that Disney was a streaming company. And they didn't remember it until Disney came out and said, hey, we're a streaming company and we're focusing more on that, right? So when that happened, it was a good time to buy Disney because everybody was taking the parks into consideration, completely pricing out streaming. And then what happened when people realized, oh, yeah, Disney has streaming too, it jumped. So you're right. You are correct. You don't have to just look at charts and technicals.
And look at the headlines right now this past week, Brandon. Disney is the second largest streamer in the world behind Netflix.
Yeah, that's awesome. Disney Plus is huge.
They're killing it. It's a monster out there. Monster. That with ESPN, ABC, Disney owns a lot of media. They control what you see.
Yep. I agree, and you could even use charting and when you're choosing to buy a stock if you're going to invest. So you can kind of do both, but you have to view your investments differently than you view your trades. Correct?
Yeah, 100%.
Okay,
100%.
Okay. So we'll continue on the balance sheets. When you look at receivables, when a company sells something to a customer on credit, it is a receivable, okay? A company makes an estimation as to how many customers will default on their payment, and they'll deduct this from their receivables, and that gives them net receivables. So if Visa, then, Visa is in the business of selling credit cards and credit and stuff like that. They'll make an estimation as to how many of these people will default, and they include that estimation by deducting it off of their balance sheet. Does that make sense?
Yep.
Okay. Now, so if a company is showing a lower percentage of net receivables to sales is usually a good thing. And that means that they have what Warren Buffett would call a competitive advantage over peers. And then you have to look, too, when you're looking at these to make sure that you're not making a mistake in the company that you buy. Can a company meet its short-term liabilities? To look at that, a good way of doing it is dividing current assets by current liabilities. If you get anything at a 1 or above, that's good. Below 1 means that the company may have a problem meeting short-term obligations. However, there's a but to this. Some great companies often have ratios less than 1. So what you have to do is you have to look at the cash that they're generating and decide if they have enough earnings power to overcome the current liabilities. And if they do, you're probably fine. Property is listed as an asset at original cost. So they buy a property, they list it as an asset at the original price that they bought it at, and then they subtract depreciation. This is sometimes listed as property / plant / equipment. Low costs are a good sign. When a company buys another company at a premium, that's where you'll see goodwill. Okay, so you see on the balance sheet there's a line item called goodwill, and this is where it's recorded. So they take the money that they paid for the company, they subtract the book value of that said company, and that's where the premium is. So Salesforce bought Slack at $27.7 billion. You would subtract whatever the actual current value of Slack is, and then the remainder there would then show up in the goodwill portion of the balance sheet. Intangible assets are assets that they cannot physically see or touch. So this includes patents, branding, copyrights, etc. Now, companies cannot legally carry internally created intangible assets on their balance sheets. So brands that they create and things like that, patents, all that stuff, they can't show that value on the balance sheet. So the company that you're looking at may have something good hidden that you can't necessarily see.
I think your mic's going in and out, sir.
Can you hear me now?
Mic check 1 2. I can hear you now.
All right. So intangible assets are assets that you can't physically touch. That's patents, branding, copyrights, etc. If a company creates a patent or a brand, they can't actually carry the value of that on their balance sheet. So that's something that you have to kind of dive deeper into a company to find, because you're not going to see it on the balance sheet. They can, however, carry intangible assets acquired from other individuals or companies on the balance sheet. Those are recorded at fair value. But here's the thing about great companies. They can't list the value of their greatest asset, which is their name, because they can't carry intangible assets that they internally create. So Coca-Cola, for example, their branding, their name is incredibly valuable, but you don't see it on the balance sheet. Long-term investments, they can only be shown on a balance sheet at their cost or market price. So these are hidden things that are on a balance sheet, by the way. So you kind of have to dig deeper into the company to see it. Long-term investments can only be shown on the balance sheet at their cost or market price, whichever is lower. They cannot be marked up even if the investment appreciates in value. This means a company that can be carrying great investments that you don't see. So that's where digging deeper, looking into the news of a company, and visiting their investor relations page, that's where all of that comes in to find out if a company is carrying something that isn't shown on the balance sheet that could be gold. Total assets and return on assets on the balance sheet. So return on assets is a ratio that measures a company's efficiency. You divide the net earnings by total assets. So here you generally want to see a high return on assets. but a company with a low amount of assets may be in an industry that has lower barriers to entry and therefore more competitive. So you kind of have to look at it like on a more balanced, with a more balanced viewpoint than just what the balance sheet shows. Because if a company can get can be good but have a small amount of assets, that means that other companies can do the same thing. And you may be looking at a very competitive industry. Okay, and then also you look at current liabilities on the balance sheet. Accounts payable is money that is owed to suppliers. Accrued expenses is liability that the company has accrued but has yet to be billed for. Short-term debt is money that is owed and due within the year. Short-term money is cheaper than long-term. So if you're looking at a financial company, oftentimes what they'll do is they will borrow short-term cash. Then they will use that money to lend it out long-term, since borrowing short is cheaper than lending long. So they'll lend it longer term at a higher rate. Then the money that is short term must be paid back in the short term, right? So some of these banks, if they're being very irresponsible, they will then borrow more short-term money to cover the previous short-term cash that they borrowed to pay that back. Now, if short-term rates jump beyond what that bank lent the money out at a long-term rate, then they're going to have a lot of problems. So stay away from financial institutions that borrow large amount of short-term money. That's something like if you're going to buy a bank, which is what everybody's telling you should do right now, you got to make sure that they are not borrowing tons of short-term money because it could be very irresponsible.
I'm enjoying this because I'm a stock geek and I love hearing these detailed explanations because they're good for people to listen to and learn from, right? You're saying stay away from people who buy short-term money. I'd like for you to tell me what stable, strong bank has not yet gone to the overnight Fed window and borrowed. Give me one major bank. Give me one.
I can't, but I can tell you one that was doing exactly what I just mentioned, and that was Bear Stearns.
Yes. Okay. All right. Yeah.
We know what happened to them.
But they all take from the cookie jar. They all go to the overnight Fed window and borrow. And lately,
yes,
in the past couple of years, they've had some scary moments of borrowing from the overnight Fed window, and people need to pay attention to that. Sorry, go ahead.
No, you're good. But then the really like the Morgan Stanleys and the JP Morgans are going to have enough cash flow on hand to cover that, even if the long-term rates jump. I'm sorry, the short-term rates jump beyond what they lent the long-term rates at. I'm stumbling over my words, but you know what? This is our second episode, so
that's fine. That's okay. Fine. But and I get what you're saying. And yes, the big JP Morgans, I love Jamie Dimon. They're gonna get through it just fine. Yes, you're right. Goldman Sachs. Goldman Sachs has enough people in our government. They're gonna be just fine. So
yeah, I hate that though. But yeah, but you just need to be careful with that. And quite frankly, you're looking at like CNBC and they're telling you to buy these banks right now. And I have to tell you, one of the reasons why banks underperformed the last 10 years was Dodd-Frank, and Dodd-Frank is still around. Okay, whatever you think of it, whether you think it stabilized banks or not, that's fine, but it also limits growth. So I don't see banks as beating the market. That's my argument on that. I don't know what you think.
Banks are going to beat the market because they made money last year because of the rebound. They made a ton of money, right? That's why you see Bank of America up at $37 a share right now. as far as like CNBC, I think CNBC is good for news, man. You got to get some news from somewhere. Of all the channels you can watch, Cheddar, Bloomberg, CNBC, Fox Business, CNBC's been around the longest. They got the biggest history. They're going to be there. There are other options, but you got to go somewhere. You got to go somewhere to watch it. You got to go somewhere to get your news. Dow Jones, Newswire, you can subscribe to that. There's a lot of options out there. There really are, but I like CNBC.
You have to be very careful with it, with what you're doing. I've noticed a lot of the times CNBC and Bloomberg and a lot of these guys are telling you to do what you probably should have done 2 weeks ago. And then 2 weeks ago, they weren't talking about what you should have been doing then either. They were talking to you about what you should have been doing 2 weeks prior to that. So you have to take what they're saying, I think, with a grain of salt. And sometimes I'll be watching it and I'll notice that I made a move or bought something. And then a couple weeks later, then they're telling everybody else to buy it. And that's when I know that I did good.
Oh, so hold up. Are you selling the news? Is that what you're doing?
Absolutely.
Selling the news. If you get nothing else from this podcast this week, sell the news.
Yes. Buy when everybody else is selling and then sell when they're
sell
buying.
The news.
Presidential election was a great example of that. I saw everybody saying, you know what, I'm going to sell right now, and then I'm going to wait until after the presidential election to buy back in. So guess what I was doing prior to the presidential
You were
election?
buying.
I was buying.
Same here.
And then I was selling to them.
Yep.
Yeah, that was the best idea to do.
Yep. And you know what? I think after this podcast, everybody knows who's Al Michaels and who's John Madden. Good job, Al. Good job, Al. And right over here, if you just move the ball to the end zone, you get a touchdown. So that is I love your technical analysis. I do. I don't want to make light of it at all for anyone who's listening. Please pay attention. He's giving you good advice and good information that you truly do need to know if you're a new investor. Yes. Yeah.
And so congratulations if you made it through my boring talk about balance sheets and income statements. I hope you weren't taking notes while you were driving. But in case you weren't, which I recommend not doing, go to chinchillapicking.com. At the end of next week, by Friday, I should have an article written up there that will have this plus more so that you can actually read the notes that I have, and even, maybe print them out if you want, because they're pretty brilliant, right?
I think so. And I'm going to have pictures of my VR, me playing VR. So that's what we're going to have there for you guys. It's going to be awesome. It's gonna be awesome. I think we're gonna end the last 5 minutes on one last comment you said you wanted to make about Mr. Warren Buffett.
Yes. Okay. So Warren Buffett, he's the Oracle of Omaha, greatest investor ever. He actually absolutely is. Okay. But he's got one mistake that he's made in the past decades of him trading, or not trading. He's investing. Sorry. Where Warren Buffett goes wrong is that he prefers manufacturing companies that produce products that do not go obsolete. That's fine. It's a good way of investing, really. But the problem with that is that that's why he traditionally has not bought software companies. He's missing the great advantage of good software companies. They have very little or sometimes zero inventory, which means very little or sometimes no shipping costs and very little or sometimes small cost of storage.
And here's Brandon. Here's my thing, dude. He's invested in Apple. I'll say that. He has invested. He stays away from technology and I like this about Buffett. He does not invest in something he does not understand. And I applaud that. I don't like it when people start trading and investing in things they don't understand, or because they heard someone else do it. And this is what I see. Being someone who has ran trading groups before on Facebook and other areas, here's what I see. If someone invests something I've mentioned or I gave a tip of in the past, and say it doesn't go as it drops right away, doesn't jump right away, right? They immediately are running to me like, what's going on?
Right.
What's happening? Why is it doing this? And, my DM box is just blowing up. That's why you should never trade something you don't understand, because you didn't understand it. You just did it because I mentioned it. Think about things, do your research, take some time to look into things and understand it. Buffett's like you said at the beginning, he's one of the best investors of all time. He only trades what he understands. So make sure you understand a company before you trade it or invest in it. Either or, I say, because you need to know what you're trading when you trade. I'm a big proponent on you only need to make 2% a trade 3 times a week, and you'll be rich in a few years. That's what I've always said. 5% a week, you do it consistently, you'll be rich. You're fine. Doesn't matter if you start when you're 50, you're 40, you're 30, you're 20. That's all you have to do.
It has to be within your circle of knowledge.
Yes.
Definitely.
Yes. You got to understand it. And you don't truly understand something until you're able to explain it to a 5-year-old, or as I say, to me. So that's what you got to be able to do.
Well, hopefully I did all right at explaining this. I lost you on video. We were on Microsoft Teams with it muted so that we could see each other talking. So earlier when I was talking about income statements and balance sheets, you heard me pause for a few minutes. And the reason why was because my phone died. And you can hear it in our ad. I'm not very technologically savvy at all. So I got very confused as to why my phone went blank.
You got to pay your phone bill, Brandon. You got to pay your phone bill.
That's it's the cost of being
right
on the ground floor, and I'm probably not going to be able to.
Here we go.
So,
all right, chinchillas. I want to say I hope we've been entertaining. I hope we've been educational, and I hope we've been uplifting, because we want everyone to make money. All right, guys. Have a good night, guys. We'll see you next